What's good, people? Welcome back to the New Financial World, Powering Tomorrow, the podcast where we break down how electricity, infrastructure, technology, crypto, and digital finance shape the real economy. I'm your host, Zach here. What if the most valuable asset owned by a Bitcoin miner isn't Bitcoin? It isn't the mining machines. It isn't even hash rate. What if the real asset is the power connection, the energizing land, the substation, the transformers, the cooling, the fiber, and the legal right to pull hundreds of megawatts from the grid? Bitcoin economics are under real pressure right now. Bitcoin traded below its estimated production cost of roughly $78,000 for 5 straight months, dropping as low as $64,700 in June. Hash price hit 5-year low, and roughly 1 in 5 miners was estimated to be operating at a loss. At the same time, AI companies are sprinting to build massive compute campuses that need huge amounts of power and cooling. And the United States is in the middle of a historic solar and battery build out that's rapidly changing where new megawatts are actually coming from. So just like y'all usually hear me say, this isn't just a story about Bitcoin. This isn't just a story about AI. And it's not just a story about solar. It is a story about what happens when multiple digital industries start competing for the same megawatt. And when the companies that built Bitcoin's physical infrastructure discover that AI may be willing to pay a little more for it. But first, before we dive in, quick disclaimer. This show is for educational, informational, and entertainment purposes only. Nothing you hear should be considered financial, investment, legal, or tax advice. Always do your own research and consult a licensed professional before making any financial decisions. All viewpoints expressed on this channel are of my own and not of those of any employer or organization. Now, let's get to it. Back in my episode about Bitcoin Vegas, I made it the simple argument. Bitcoin does not run on vibes. It runs on power, it runs on transformers, cooling, it runs on capital, and it runs on industrial infrastructure. So, where is the infrastructure going now? Because Bitcoin miners spent more than a decade searching for cheap electricity, developing large industrial sites, building substations, negotiating power agreements, installing cooling systems, and learning how to operate high-density computing equipment around the clock. Now, artificial intelligence companies need many of those same physical resources. But let's make an important distinction right away. Most Bitcoin miners are not becoming hyperscalers in a strict sense. They're not suddenly becoming Amazon Web Services or Microsoft Azure or Google Cloud. Many are becoming something significantly different. Hyperscaler infrastructure providers, power land developers, data center landlords, coalition operators, AI cloud providers, and infrastructure partners serving hyperscalers, neoclouds, and AI laboratories. That distinction matters because you do not turn a Bitcoin mining machine into an AI computer. You turn a power site into a different class of data center. Today, we are going to break down why Bitcoin hash rate and mining economics came under pressure, why miners are moving toward AI and high-performance computing, why the power interconnection may be more valuable than the mining equipment, how solar and battery construction fit into the AI race, and what perovskite or perovskite, whichever one you prefer. To me, it seems like it's pronounced perovskite. It sounds Russian, but I don't know if it is or not. I don't want to stereotype. But it could change about the next generation solar. This is where a hash power meets hyperscale. Let's start with why some miners are even considering AI in the first place. Hash rate. It's the total computing power securing the Bitcoin network. For years, it mostly moved in one direction, up. But mining is still a business, and every machine has a break-even point. Here's the picture. In 2026, Bitcoin spent 5 consecutive months trading below its roughly $78,000 estimated production cost. Now, hash price, the revenue a miner earns per unit of computing power. It fell over a 5-year low. Mining difficulty swung sharply, including one of the largest drops of 2026 in February. Now, when revenue falls below the cost of running a machine, the operator has three choices: find cheaper power, run only during profitable hours, or shut the machine off. By mid 2026, an estimated 20% of miners were operating unprofitably, and public mining companies had sold more than 32,000 Bitcoin in the first quarter, just to cover costs. Older and mid-generation machines stopped working economically first, even if they still work technically, and when those machines shut down, something important happens. The physical power capacity behind them doesn't disappear. It becomes available for something else. The ASICs might be standard, but the megawatts are not. Now, I want to clear some things up. This is where a lot of headlines get sloppy. People say Bitcoin miners are converting their rigs into AI. That's not what's actually happening. A Bitcoin ASIC is an application-specific integrated circuit built for one job: the SHA-256 hashing process that secures Bitcoin. It can't train a language model. It can't train AI interface. It can't flash new firmware and magically turn it into a NVIDIA GPU. The ASIC is not the transferable asset. The site is. The power connection, the land, the substation, the permits, the utility relationship, and the experienced workforce, the cooling, and sometimes the fiber outputs or the fiber routes. Turning a Bitcoin mine into an AI data center is not just swapping computers. AI facilities need high power quality, stronger redundancy, low latency networking, tighter temperature and humidity control, and increasingly direct-to-chip liquid cooling. A Bitcoin mine can't afford to be interrupted. If power prices spike or the grid is stressed, miners can curtail and come back later. An AI customer paying for a giant GPU cluster is buying availability. If cooling fails or power dips or drops unexpectedly, the financial consequences can be huge. So the accurate description is this: Bitcoin miners are not turning ASICs into AI chips. They are converting electrical and industrial sites into AI-capable infrastructure. And not every site will qualify. Right now, the AI industry's biggest constraint is no longer just access to chips. It is access to chips inside buildings that can actually power and cool them. A hyperscaler facility might need hundreds of megawatts and years of planning. The data center might be designed in 1 to 3 years, but the grid infrastructure feeding it often moves much slower. We've talked about this in many of episodes, how the sequencing is really what puts a chokehold on a lot of things when you have technology outpacing the actual regulatory frameworks. That's kind of why a lot of people are trying to push for the Clarity Act to be passed, because it's actually another portion to this as well. But new generation takes time. Transmission takes time. Substations and large transformers and interconnection studies all take time. The AI company wants compute next year. The utility might need 5 or more years to build it out to the grid. This timing mismatch is why existing mining sites suddenly look interesting. They may already have a utility-approved interconnection and functioning substations, transmission access, industrial-zoned land, cooling systems, water rights, and communities that has already accepted a large digital load. That can cut years off the development process. But how quickly can those megawatts be delivered to working infrastructure? That's another story, because we're talking about energized land with real electrical path. Fiber and permits is becoming a strategic asset class. Land without an electrical path is just land. There is no single miner to AI playbook. Let's look at 2 clear examples happening in real time: TeraWulf and the campus lease model. On July 6, 2026, TeraWulf signed a 20-year lease with Anthropic for a purpose-built AI campus in Howsonville. Don't quote me on that. I got it on the bottom. It's Hossville, Kentucky, converging 400 and 1 megawatts of critical IT load. The deal is expected to generate roughly $19 billion in contracted revenue over its term. Initial capacity is expected online in the second half of 2027, with the full ramp up by early 2028. On that same day, TeraWulf sold its major stakes in a separate Texas joint venture, recycling capital from the one project to fund growth in another.
And today, it announced a nearly $1 billion in capital raised to fund a data center build-out in Kentucky. Let's welcome back in Paul Prager. He is CEO of TeraWulf. Paul, great to have you on the program. We actually had one of your board members on Monday, Michael Buchella, and that kind of got us thinking to have you on. So thank you for coming on. Why sell 47.4 million shares of stock? What are you going to do with the money?
We sold it because we could. I mean, typically, we would take a sort of lower risk strategy of raising some equity after we've signed a new tenant deal. But there was tremendous opportunity in the market due to primarily a scarcity of financial product for HPC AI folks and the scarcity of power to meet the AI demand. So we played offense instead of a more reserved approach to go out and raise that capital yesterday, and we did it with the help of Morgan Stanley, Bill Graham, and Cantor Fitz, Pascal Bandelier, our equity advisor. They did a fantastic job together with, of course, Patrick Fleury, our CFO, management team. Just nailed it. And so we brought home, it'll be a little bit over $1 billion with the shoe having been filled.
This is the modern playbook. Take a site with the existing industrial scale power access and convert it into a long-term contracted revenue stream. Core Scientific and the coalition model. Core Scientific now has approximately 590 megawatts contracted to CoreWeave across Texas, Georgia, Oklahoma, and North Carolina. The relationship is now worth more than $10 billion in contracted revenue. Core Scientific has also disclosed a leasable power pipeline approaching 3 gigawatts in future deployment. And to be precise, CoreWeave is a tenant and customer and not a parent company. A Purpose 2025 merger between the two were rejected by Core Scientific shareholders and formally terminated. So this is a landlord and coalition relationship, not a corporate integration. The pattern across both models is clear. Bitcoin mining revenue is volatile and market dictated. AI infrastructure revenue can be structured as long-term contracted cash flow, which is exactly why banks and infrastructure investors are willing to finance it. But it isn't free money. These deals require billions in new buildings, transformers, cooling, and networking. The operator trademark price risk for construction and counterparty risk. Bitcoin and AI both consume electricity, but they don't consume it in the same way. Bitcoin mining can be highly flexible. When wholesale prices spike or the grid calls for relief, miners can ramp down. When prices fall, then spin back up, that makes mining an excellent candidate for demand response and grid balancing, especially when margins are thin and operators are sensitive to power costs. AI is different. Some training jobs can be scheduled, and some batch workloads can chase lower cost hours. But large AI campuses are usually designed around high utilization and strong uptime commitment. If you've invested billions in GPUs, you don't want them sitting idle whenever the grid is stressed. And if you're running real-time interface for customers, you may not be able to shut down during peak hours. So in grid terms, Bitcoin mining is an interruptible, flexible load. AI is trying to be a firm, high availability load. That creates a powerful hybrid model. Imagine a large industrial campus where AI is the high-value anchor tenant. Bitcoin mining is the flexible secondary load. Solar provides the low marginal cost, daytime energy. Batteries smooth out short-term fluctuations and shift surplus into the evening. And grid power, or firm generation, provides backbone reliability. When power is abundant, and cheap, both AI and Bitcoin run. When the grid is stressed, Bitcoin curtails first. AI stays online. The structure won't fit every market or tariff, but it is one of the most interesting ways to combine flexibility, revenue, and reliability on the same site. Now let's move to the supply side. The EIA projects developers will add 86 gigawatts of new utility scale generating capacity in 2026, a record and the largest single-year jump since 2022. Why is solar winning so much new construction? It's modular, fast to deploy, and once built, has no fuel supply chain. But energy is not the same as capacity. A 500 megawatt solar farm doesn't produce 500 megawatts every hour. Output swings with time of day and weather. AI doesn't shut down when the sun sets. Batteries help bridge the gap, shifting solar into the evening and stabilizing the grid. But a 4-hour battery is not a 4-day fuel supply. So the realistic AI power stack is solar for cheap energy, batteries for shifting and stability, and firm generation for the hours renewables can't recover. Which brings us to where I want to talk about the Russian-sounding material, perovskite. I hope I said that right. I like my little Russian accent. I got that black Russian in me. Perovskite. Sorry. The original perovskite material was discovered in Russia's Ural Mountains in the 1800s and named after Lev Perovsky. Today, perovskite refers to a whole family of materials with a similar crystal structure. And certain metal halide perovskites are very good at converting sunlight into electricity. What makes them interesting is how they can be processed. You can turn the active material into a kind of semiconductor ink that can be coated or printed as an extremely thin layer. That's why some people you might hear when they mention some of the new solar technology talk about paintable solar. But in practice, it's not as simple as rolling paint onto a wall. These are controlled, high-precision manufacturing processes.
This transparent perovskite solar cell could be on your home or office building in the near future. Panasonic is literally printing solar panels onto glass windows. I partnered with Panasonic at CES and was very excited to see what they're doing with this tech. Perovskite is a crystalline material that's really efficient at converting sunlight to electricity. Unlike traditional silicon panels, it can be dissolved into an ink and printed onto surfaces. Panasonic uses inkjet printing to deposit this solar material directly onto the glass in precise patterns. See these leaf patterns? That's not decoration. The dark areas are the actual solar cells generating power, and the clear areas let light pass through. When they're designing these panels, they can choose how much glass to cover. More coverage means more power generation, but less transparency. Less coverage keeps the glass clearer, but produces less electricity. It's a trade-off that they dial in during manufacturing based on what the building needs. These panels can be made up to about 1 meter by 1.8 meters, roughly the size of a large office window. And Panasonic is targeting a 20-plus year lifespan, similar to traditional solar panels. The goal here is building integrated solar, windows that generate power while still functioning as windows. Instead of bolting panels onto your roof, the building envelope itself becomes the power source. And while this is still in development, they've proven that the technology works and are now working on scaling it up for mass production. Solar panels that you can see through, printed like a document from your inkjet printer. The future is weird, and I'm here for it.
Perovskite captures a different slice, stack them, and handles their wavelengths it's best at. Instead of forcing one material to do all the work, you let two materials divide the spectrum and sequence more energy out the same physical area. Early commercial perovskite silicone tandem modules have already shown a double-digit percentage increase in energy per square meter. That matters for data centers, rooftops, warehouse, urban sites, and industrial campuses, where roof or land area is limited. The catch is durability and scale. Perovskite materials can degrade under heat, moisture, oxygen, and UV light. Researchers are improving stability, but the industry still has to prove that these tandems can survive decades in the field and pass bankable tests at scale. Perovskite doesn't replace silicone tomorrow. It rides on top of silicone squeezing more energy from every square meter, which is exactly what digital campuses care about. Let's bring the conversation back to the grid. A 100 megawatt Bitcoin mine and a 100 megawatt AI facility might have the same nameplate demand, but they do not look the same to utilities. A mining site can ramp down during price spikes or emergencies. An AI campus wants continuous operation, redundant feeds, and tighter power quality limits, and is far less willing to curtail paying workloads. So when a mining site converts to AI, the utility has to reevaluate load factor, ramp rate, power quality requirements, transmission and substation upgrades, and critically, who pays for it? The conversation is changing to where those costs aren't going to fall on residential or small business electric bills. Large load tariffs need to reflect the real cost of service. This is also where reliability becomes financial. A multi-billion-dollar AI contract depends on proving the power was available and commitments were met. You're not just financing servers, you're financing the reliability of the entire power to compute stack. So, are miners abandoning Bitcoin? Some are leaning hard into AI, some are keeping both, with Bitcoin as the flexibility layer around firm AI loads. Some remain focused on Bitcoin, especially where they have cheap power and modern machines. The real shift is mental, from Bitcoin producer to digital load operator. The real asset is the ability to convert electricity into valuable computation. Bitcoin hashing, AI training, AI interface, cloud services, and allocate megawatts towards whatever offers the best risk-adjusted return. Solar helps because it can be deployed quickly. Batteries help because they stabilize and shift energy. Perovskite tandems may eventually squeeze more electricity from the same roofs and land, but none of this erases the need for power, substations, cooling, protection systems, and operational discipline. Solar is winning the race to build new energy. AI is winning the race to pay for reliable compute. Bitcoin remains one of the most flexible ways to monetize electricity. And the computation connecting all three is no longer about software alone. It's about the megawatt, where it is located, when it was available, what workload it serves, and who can prove the system stayed online. That is the transaction from Hashrate to Hyperscale. That wraps up the New Financial World Powering Tomorrow podcast. The future of AI is not floating in the cloud, it's anchored to electrons and is sitting in industrial land connected to substations, cooled by mechanical systems, backed by power contracts, supported by solar, storage, and firm generation, and increasingly developed by companies that began by mining Bitcoin. The next digital economy will not be won only by the best algorithm. It will be won by the system that can deliver real power, real cooling, reliable compute, and reliable evidence that everything performed as promised. Until next time, learn, adapt, prosper. And as always, stay energized.